Hey, good afternoon, everyone.
Hello, Professor. How are you?
Yeah, how are you, Claudia?
Hello, Professor.
Yeah, hi, Braylon.
Hello, Professor.
How are you,
Good
Maria?
afternoon.
How are you, Tia? Well, I see. Good afternoon, Alicia. I see 11 people here, and so let me check how many people are in today's forum. You see, okay, I see only 5 people. Uh, so this is the thing. You need to if you are not in the today's forum, if you haven't signed into this, that's the first thing before you come to the collaborate session, right? Please sign into the discussion board first. That's the first thing, right? So if you're not in here yet, please do so ASAP because that's the physical proof. That's the physical proof of your attendance. All righty, I see 13 people, and I still okay, and I see only 11. Two more people still need to sign in. All right, and uh, I believe the rest of the class will all be signed into today's forum pretty soon. So, a couple of things before we move on. Um, I made a couple of announcements over the last couple of days, right? So going to the announcements. Okay. Uh, this is it basically. You all know,
Hey,
you all
Professor, I
know.
can't hear you. I believe you're muted.
Uh, I'm not muted. Can you hear me?
I can hear you just fine.
Okay. Sometimes it looks like there's a some disruption off and on. Maybe it's my connection on my side. Uh, but if you don't hear me, just let me know. So you're fine now. You can hear me now, right? Is that right? You can hear me? No?
Yes.
Okay. I heard barely. I heard someone. Okay, good, good. Um, we'll just have to. Okay. Yeah. Uh, so, uh, first thing, you all know there's a self-diagnostic test starting tomorrow, right? Everyone is aware of that. Uh, and then Excel certification training. This one, uh, you will get a certificate. After this training, you'll get a certificate. Usually, the certificate cost. I mean, the test certificate exam cost $100. But it's all sponsored by BMCC, so you won't pay anything. It's free. Okay. Uh, and when you have this certificate, it's definitely an advantage. It's a plus on your resume. I mean, uh, applying for a job that will put you at advantage. And then uh, the Connect site link is now up and running. Okay, so click on that, and then you use BMCC email. Please use BMCC email, right? And then continue, and then alrighty. So that's basically it. Let me see. All right, I see 17 people here, and then uh, and only 15 people. So two two people that 2 people out of these 17 are not here. that's fine. Hopefully they will also join our collaborate session. So now today we are moving on to the next segment, next section. So we talked about we basically finished everything about annualized return, right? Oops, that's not what I was trying to show this. Yeah, annual, and basically return, it's an annualized concept, and a very typical ROI, in other words, return on investment, a very typical one is the interest rate. Yeah, right? I don't know if you've ever thought about it, but interest rate is basically return on your money, right? Interest rate is the return on your money, basically. And it's annual. All interest rates are basically annual, quoted as annual rate. And the interest rate is basically the lowest form of return on your investment. And you probably never thought about it as an investment, but when you put your money in the bank, right, you don't consciously invest that money. You leave it with the bank, but the bank invests it basically, right? So you are vicariously investing. You're investing vicariously, right, through the bank. But of course, in all investing involves risk. There is no investing without risk. Everything is a risk if you think about it, right? But only as the saying goes, the higher the return, the higher the risk, the higher the return. Higher the risk, the higher the return, right? Everyone must have heard about it at one point or another. So think about it. There is no reward without taking the risk, right? But putting your money in the bank, you take no risk. There's no risk. You're not running any risk. But think about it. Because you're not running any risk, that's why the the interest rate, return on your money, is so low. I mean, what kind of interest rate do you get? What kind of interest rate do you get on savings account? These days, everyone knows, you're not getting anything, significant. Does anyone have a savings account? I'm sure you all have some sort of, savings account.
Yeah, you get
Right?
like maybe a few cents for every $100,000.
Every 100,000? Maybe not every 100,000, but every $100.
No, I'm saying every 100 to 1,000.
Yeah, think about it, in percentage, that's not even 0.1%, right? It's not even 0.1%, right? That's what it really is. You don't get. I mean, it's like for every $100 you get, let's say, if you put 1,000, you get, like for 1,000, you get $1, even less, maybe 10 cents, right? So that's really, really outrageous. I mean, it's just immaterial. But it wasn't always like this. It wasn't always like this. It was back in 1982, 83, even until 85, you got about 10 to 15%. You got about 10 to 15%. And you might say that's crazy. If you can get 10% interest or 15% interest on your savings, on your deposit, savings deposit, then who's gonna take the risk? Who's gonna run the risk of losing money and by investing in the stock market? Yeah, it was like that actually in the early 80s. Um, when interest rate, think about it, when interest rate is basically a contract. It's a promise. It's a contract by the bank, by the lender, to pay that interest, regardless of no matter what, right? So if they make the bank is basically in the business of lending money, right? In other words, what I'm saying is the main business of banking is in lending money. You might say, oh, don't they also take deposit? Don't they take deposit? Yes, they take deposit, but when they take deposit, in other words, they will have to pay interest to you, right? But they have to make that interest somewhere. They have to earn that interest somewhere to pay you that interest. So how do they earn that interest? By lending money, right? So the business of banking is mainly in lending. So if you deposit, think about it. If you deposit $1 million, they make money by lending that $1 million. And when they lend, they charge something like 10%. And then, so they suppose they charge 10%. So that means annually they will collect $100,000 as interest, right? By lending your money, right? So that's why they call it other people's money, OPM, other people's money. Basically, the bank is in the business of lending other people's money, right? They lend your $1 million and collect 10% on it. But when they pay interest to you, they pay not even 0.1%. So think about it. 1% of 1 million is 10,000. So 0.1% is like 1,000. They don't even pay 0.1%. They pay probably like $100 for 1 million, 0.01%. But as I said, in 1980s, early 1980s, it wasn't like this. They were paying like 10% interest. But so you might wonder, when did they start paying this ridiculously low interest rate? Does anyone have any idea? Anyone? Since when? Since when did
After
they?
the recession of the 08?
Yeah, 2008, right? Maria, that was Maria, right?
Yes.
Yeah, they still have 0.1%. Yes. So Maria, I will give you Maria Cervantes. I will give you 0.5. This is section 1401. Yeah, and also somebody dropped Claudia Joseph. Yeah, they still have 0.1% interest rate. Yeah, you're right. But my question was, since when did they start paying this low interest rate? 2008. So what happened in 2008? We all know in 2008 there was a financial crisis, right? Full-blown global. Yeah, and that was the onset of the recession. That global full-blown financial crisis. That was the onset of the recession started that year. And then since 2008, the economy actually bottomed out in like 2009, 2000. the economy bottomed out. So then after it bottomed out, it was on the path of recovery. But so recovery took almost like a decade, right? Of course, from the minute it bottomed out, it started to recover. But to fully regain the pre-recession level of economic growth, it took almost a decade. And then we were about to, the economy was like back on the pre-recession level by about 2018. And then 2020, the pandemic hit. And there was a very brief recession, but we didn't really have a full-blown recession during the pandemic, right? Thanks to the
Physical
stimulus
policy?
check. Say that again?
Physical policy?
No, it's monetary policy, mainly monetary policy, not fiscal
No,
policy.
because I learned that the physical policy actually means the stimulus checks.
Yeah. That's right. I mean, if you mean stimulus check, yeah, it's fiscal policy. Yes, definitely, you're right. Basically, you have to think about it. To pay everyone stimulus check, right? The government has to borrow money, right? To borrow money, that creates debt, right? And
For banks to borrow money, don't they go to the Federal Reserve window?
no, they can. They sell. That's true. They sell bonds. They sell, treasury. So basically, they will have to go through. They will have to go through the Federal Reserve to sell more bonds. And then, actually through the Federal Reserve, and actually, how do people actually buy treasury bond? Actually, they can buy from, retail banks, from commercial banks, right? So the bonds are basically, sold through the Federal Reserve window, but the banks buy from them, and in banks, so banks are like commercial banks are like actual window for average retail buyers, right? But then the fiscal stimulus, the fiscal policy, when you sell more treasury bonds, that's a separate thing from the monetary policy. That's completely a separate, different thing from monetary policy. So, I want to show you basically, this is what happened, before and after, right? So actually, what caused the financial crisis? We know in 2008 we had a financial crisis, but the financial crisis was actually preceded by another event. What preceded the financial crisis? Anyone remembers? I mean, if you
The prices of the house went up.
yeah. Housing market, subprime mortgage crisis. So who said that? Who said that?
Maria?
Maria. Okay, Maria again. So Maria, you got another 0.5. Yeah, before the financial crisis, there was what they call subprime mortgage crisis. I mean, if you guys are just about 18, 19, 20, 21, you probably wouldn't remember. But if you are at least a teenager in 2008, you would probably actually felt it firsthand, right? So the housing market crisis was basically it broke out because prior to that, I don't want to go into the history of that, but in early 2000s, the economy wasn't growing that much. Economic growth rate was very low, but the banking sector had a lot of money. And as I said, the main business of banking is in lending, because banks make money by lending money, right? And then since the economy was not growing, it was not easy to make loans to the businesses. They couldn't, businesses were not even trying to borrow money from the bank, because businesses borrow money only if the economic outlook is positive. When you have think about it. If the economic outlook is positive, then they will need to expand their production capacity, right? Does that make sense? Because with positive economic outlook, the demand for their products will grow. Now think of it this way: if the economic growth rate is 10%, okay, that's if the this is growth rate, right? If the economic growth rate is 10%, what does that mean? On average, everyone's income will, the GDP will grow by 10%. If GDP grows by 10%, right, that means on average, everybody's income grows by 10% on average, right? And if everybody's income grows by 10% on average, then more or less everybody's spending or consumption grows by 10% on average, right? So then the demand for your product, consider company X, right? Let's say company X makes whatever. Company X's demand for company X's product will also grow by 10% on average, right? And then think about it. If this company is running at full capacity, if the company is currently running at full capacity, they don't have any slack. In other words, they cannot accommodate this 10% growth in their demand. So what should they do? They will have to increase their production capacity by 10%, which means they will have to build another plant, or at least expand their current facility by 10%, expand their current plant size by 10%, right? But then to do that, they will need money, right? They will need capital, so they go to the bank and they borrow. But think about it. That only happens when economic outlook is positive, right? This positive economic outlook. And then, of course, if they are not running or at full capacity, if they have like 10% slack, they won't need to do this, right? But then, if the next year's economic outlook for the next 5 years, if the economic outlook for the next 5 years is like 10% annual growth, then even if they currently have 10% excess capacity, that's not going to be enough. Next year they may be able to meet the demand, right? But from the year after next, then they won't be able to meet the demand. So they will need to expand their production capacity. So they will need to raise capital to do that. So what do? They go to the bank and they borrow money. But then think about it. If this is negative or 0% or negative, like economic growth outlook, growth rate is expected to be a negative. There is no reason they would do this. And I told you in the early 2000s it was like not negative but like almost very low, close to zero. So then businesses don't borrow, but the banks were loaded with money. The banks were loaded with money. They had so much money, and so, and if they are not lending this money, they will be only paying interest. Think about it. They have deposit. They will have to. They are loaded with money. That means there's so much deposit, right? And then they have to pay interest. But if they can't lend money, then they cannot make interest. They cannot earn that interest to pay the depositors. So what they came up with was, think about it. The industrial sector of the economy isn't growing that much, but so they then where would they lend to make money? They looked into the housing market, because if you lend to housing market, right, default risk is very low. Why? I mean, the default risk is what? When the borrower cannot pay anymore, when the borrower cannot make payment, then they default. But this risk is very low. Why? First of all, when you lend money to a home buyer, that's called mortgage loan, and the home buyer will buy a house, and the house becomes a collateral, right? So in other words, when they start to default, think about it. The borrower will make payment. The borrower will make payment as long as the borrower has a regular, good-paying job. They can make monthly payments. But if they default, what can the bank do? The bank will then, if the borrower defaults, what will the bank do? Anyone? Come on, you heard me.
May you repeat the question?
Yeah, the question is, when the borrower defaults, what will the bank do?
Put up the interest rate?
Or a lien.
Put up the interest rate. Look, the borrower cannot make any payment. That's why they defaulted. The borrower, that's why he or she defaulted. And how can you raise interest? If you raise interest, the more this.
They're not going to want to borrow.
Not only that, the existing borrower. Look, I've been explaining to you. I was talking about the home mortgage situation, right? So someone borrowed money to buy a house. They bought a house, and then they start making monthly payments. But then they default. What will the yeah? Someone said okay. Claudia said lien. Yeah, lien is okay. That's right. But lien is already put on. Yeah, because listen, the house was already put up as collateral. When you borrow money to buy a
I
house.
think the bank can take your house.
Yes. Who said that? Who said that? Who said it? The bank will, in other words, the bank will foreclose on your house. The bank will foreclose on your property. They will take your house. And who said that? I heard someone say that. Look, if you don't, identify yourself, you lose that 0.5. Okay, nobody. Yes, the lien means, right? Someone said lien. That was what I was saying. Okay, Claudia, so that was you. Yeah, but
No, the last comment was not me, but I was saying that before. But I don't know. I was speaking and somebody else was speaking, so I don't know if like it went through, so I typed it in.
Oh, okay. Maria, you said that. Why don't you? Alrighty. So both Maria and Claudia, you get 0.5. Yes, of course. Just use the common. This is the common sense. If you borrowed, if you have a mortgage loan, right? You borrowed money to buy a house, and if you default, then of course just one default, they won't take away your house. But if you repeatedly default, then they will. And lien is basically the legal right to repossess the property, right? On that they put on the collateral. So think about it. When you borrow money to buy a house or buy a car, the house and the car automatically become collateral, right? So that's why they can lend without any. What did I do? I was sharing the screen, and I guess I accidentally. So that's called, self-collateralizing. They self-collateralize, right? These house and the car self-collateralize. So yeah, because it's a collateral, they basically in early 2000s, they basically looked into the housing market, and they started instead of because the industrial sector wasn't growing, so they basically turned the direction and started lending to the housing market. And in early 2000s, the interest rate was low. It wasn't as low as currently, but the interest rates were generally historically low in early 2000. So this was and the banks were lending easily those days because think about it. It's a win-win situation for the bank. Right? When we say win-win situation, it's the win-win situation for both parties. That's usually when you say that. But at that time, it was a win-win situation for the bank only. Why? Because think about it. When the borrower is making payment, borrower doesn't default and makes payment, then the bank wins anyway, because the bank receives payment. The payment includes both partial principal and partial interest. So bank wins. Bank will, and then if the borrower defaults, they will foreclose on the property. And when they foreclose on the property, they resell it, they sell it, and then they recover their principal. So they still win, right? That's basically, that's why I'm saying, that's why I said it was a win-win situation for the bank. So in the early 2000s, all the banks were in an all-out war to make these, loans to the housing market. And think about it, between the banks, this is a competition, because the bigger banks, the more market share they have, the more market share. It's also in any industry, the more market share you have, the bigger you are. And the bigger you are, the more market share you have, and the more revenue the bigger market share will generate, right? So that was what was happening in early 2000s, but housing market crashed in 2007, right? Why? Because during the early 2000s, because all these banks were in an all-out war with each other to maximize their lending, right, to gain more market share, they started to lend to even the subprime category borrowers. Subprime category. So subprime category borrowers mean basically people who have very low credit scores and people who don't have like regular jobs, or in other words, people who wouldn't normally qualify to get that loan, but they were doing it anyway because they were, in a stiff competition with each other. But then, what happened starting from 2006, actually starting from 2005, the Federal Reserve started raising interest rate. Previously, the interest rate was somewhere around the benchmark rate. The graph that you are seeing here is the benchmark rate. So it was, let's say, around 1.25. Even in 2005, it was around 1.25 or something like that. And over just 1 year, they raised it by 4%. Between 2005, January of 2005 and 2006, they raised it to something like 4.25. So just about 4% over just 1 year. And then during 2006, they raised it another 1%. So over 2 years, the benchmark rate went up by 5%. Now, when the benchmark rate goes up by 5%, all interest rate would also go up by the same magnitude or more. Now, here's the thing. Usually, when you get a loan from the bank, right? When you get a loan from the bank, your interest rate is fixed, right? Loan is a contract, basically. So if you borrow $1 million for 10 years, or for during those 10 years, and if your interest rate is 5%, that 5% interest rate is fixed, right, for the duration of the contract. So regardless of what the market rate is, you will pay 5% throughout the entire loan period. So everyone, that's why when you get a loan, you try to lock into the lowest rate. You try to lock into a lowest rate. But think about it. During the subprime category borrowers, they didn't qualify. Actually, normally they wouldn't qualify, but they were getting a loan during those days anyway. And because they were subprime category, that means what? They are very risky. They are very risky borrowers. From the bank lender's perspective, they were very risky borrowers. So they didn't get the fixed rate. They got the floating rate or adjustable rate. So that means the rate will adjust with the market rate. So when benchmark rate went up by like 5% over just 2 years, these people, their rate adjusted too. Subprime category borrowers rate adjusted too. So their rate went up by 10% or whatever. Then this becomes unbearable, right? This becomes unbearable. These people suddenly, they were paying like 5% a year. Suddenly it's 15%. They can't handle that. So what happens? They default by massive numbers, massive quantity. They defaulted, and the banks foreclosed these, properties on massive scale. Now think about it. When you foreclose a $1 million home, right? And if it is just on the normal situation, right? This $1 million home can be resold for 1 million, right? But then the bank recovers 1 million. Think about it. Where did this 1 million come from? Think about it. Where did this 1 million come from? Anybody? The bank loaned 1 million to the borrower, right? Who bought a house with that loan. But this 1 million that came from the bank, this 1 million, where did it come from originally? Where did it come from?
From other people?
Yeah, from other people. Yes, from the depositors, basically. It's depositors' money, the savers' money, right? So think about it. And then the bank loaned this 1 million to this home buyer, but bank owes the depositor 1 million, right? But then think about it. Under normal circumstances, under normal situation, in the normal market situation, when you foreclose a $1 million home and then resell it in the market, you will recover 1 million. Then you can pay back, eventually to the saver who saved 1 million, right, with the bank. But when subprime mortgage crisis broke out, there were massive number of properties that were foreclosed and massive number of properties that were put on the resale market. Now think what's going to happen to the price of these repossessed homes. What's going to happen to the price?
Does it go up?
Down.
Why would it go up?
They're gonna drop.
Down.
It's going to have, it's going to have to drop drastically because there was a massive number of properties that are put on the market to sell. That means when there's more supply, when there's more supply, always, when there's more supply, suddenly increased supply, the price will have to drop, right? So that's what, then there was a massive,
Sorry. I'm guessing when it's the other way around, when it's very limited, then the price goes up.
Yeah, when the supply is limited, right? Think about it. When the supply is limited, then the price goes up. It's basic law of demand and supply. Now let's take a look at this. The horizontal axis is quantity, right? Vertical axis is price. So let's say, and the demand curve looks like this, okay? The supply curve looks like this. So demand is, think about it. This is what demand looks like. When the price is very high, demand is low. Yeah, think of it. And when demand price is low, demand is high. Right? Makes sense. That's very straightforward. But so if iPhone is only $200, iPhone 13 is only $300, the demand will be like this. If iPhone 13 is what? 1,500, 1,300. That's why current demand is like this. You might think suppose iPhone 13 is like this. The demand will definitely like this. Demand will be much greater than what it is now, right? But think about it. When supply increases, that means what? Supply curve is shifting to the right like this. S prime is the new. That means at every price level, at every price level, you have, at every price level, you have more quantity, right? You have more quantity supplied. But then what happens to the price? Look, price was previously, price was P0, that's right. That's before the housing market crisis, right? When you put, $1 million home on the resale market, right? Let's say quantity 0. The price would be this, and let's say that was $1 million. But when there is a massive supply of foreclosed homes trying to sell in the resale market, right? Trying to sell it in the market, then the new price, and this is equilibrium at time 0, original equilibrium, and then when you this is quantity 1, new price level. Now we can price 1, and then this is new equilibrium, so equilibrium 1. So what do you see? There are more houses to sell, but the price will go down because there are more. And the opposite is true. When supply, this is more supply. When there is less supply, right? Meaning supply curve shift in like this. If the supply curve shifts in like this, then think about it. I call this S double prime, and then price will go, right? And then this is quantity 2. Yeah, supply shifted, supply decreased. So the quantity in the market is, this is 2, quantity 2, and equilibrium 2, right? So think about it. Price goes up, right? But what happened in 2007 was this, right? So then think about it. If the $1 million homes are, if the prices are slashed by half, then all they can recover is only 50% of what the banks originally owe their depositors. This is a big problem, right? So what do the banks do? So how does that? We understand that that's a housing market crisis, but how does that develop into the how does that escalate into the financial crisis? Now think about it. If this is the case, then the banks will have to grab every penny they can, because when the depositors want to withdraw their money, they must have that money ready. The foreclosed homes, some of them are sold, some of them are not sold, but what they can recover from, basically bottom line is what they can recover from selling these repossessed homes won't be enough to meet the demand for withdrawal, right? When the depositors withdraw. So then the banks will have to limit lending. They will have to muster, or they will have to hold on to every reserve that they have bank, right? To meet the withdrawal demand, because if they don't have money to give out when the depositor demands it, then the bank goes bankrupt, right? They don't want that situation. Of course, the banks are insured by FDIC, so the bank, your deposit in the bank is insured, but then that it's not unlimited. The FDIC, the Federal Deposit Insurance Corporation, is the bank's insurance. They only insure up to $250,000, $250,000, right, per account. So if you have $1 million in the bank, and that cannot, even the FDIC cannot guarantee all of that, right? So if the bank cannot pay you, you are the depositor of that 1 million. If the bank cannot give you, when you demand that, when you withdraw 1 million, and if the bank cannot come up with that, then the bank will go bankrupt. So the bank is, trying to grab every reserve they can grab. To do that, they will have to limit lending. They will have to stop lending, right? So lending became very difficult. Lending, that's when they say money dried up, money supply dried up, because in the financial market, when business, anybody who wants to borrow, businesses that want to borrow, they go to the bank, but then it's very hard to borrow. It's difficult to borrow because banks are limiting lending. So when that's called credit crunch. That was called credit crunch back in 2008. Credit crunch means lending is limited, so the money supply, credit. In other words, there was a credit crunch, and the money supply in the economy dried up, and then those the Wall Street. The Wall Street banks, Lehman Brothers, and AIG, Goldman Sachs, their money supply also dried up. Their cash flow dried up, and they are basically also investment banks, and they have to. They're also not only doing the investment banking, but they also broker investment deals, and also they lend, borrow, and one of them, first it was Bear Stearns, but Bear Stearns was bailed out. In other words, they went bankrupt, but the government, right, used public money to bail them out. So Bear Stearns was later Bear Stearns was later acquired, and that was under the condition that they would bail out, under the condition that Morgan's, J.P. Morgan would take over. So it was actually absorbed, merged by J.P. Morgan, and part of it was probably Bank of America merged it, and then second one was Lehman Brothers, but this time they didn't bail out; they let them go bankrupt. So that was what started the financial crisis in 2008. Now, that was a long story, but this explains why interest rate was this high and then dropped like this. So I'm gonna come back. It's already 5:56, so we're gonna take a 10-minute break, and when we come back, we're gonna come back to that. Okay. Alrighty. So let's take a 10-minute break. Okay. All right, we're back. We're back. So, where was I? Oh, yeah. So, the financial crisis that happened in 2008, right? Um, it when the economy, think about it. First of all, um, I said, in the first hour, right before right before we went to break, I said uh, the financial crisis. The first symptom of financial crisis was credit crunch. In other words, the banks are not lending because they have to garner, or they have to save every penny they can to meet the demand for withdrawal. So the credit, in other words, the money supply in the economy dried up. Then, as the money supply dried up, then the businesses started to go bankrupt because all the businesses have payment obligations to meet um, uh, uh, every day, every week, they have every month, they have payments that become mature, and they have to meet these payments. And sometimes they have to borrow short term. It's not that they don't have it's not that they don't have money. I mean, they just don't have cash flow. They have sale, they have revenue, but these are accounts receivable. Um, so, in other words, they don't receive payment right away. They receive payments in 1 month or 2 months. So during this time when um, they have during this time when their accounts payable become due, right? They have accounts payable, and then they don't have yet cash flow, but everything is just on the book. The sales revenue is on the book, and they are just accounts receivable so far. Then they cannot meet these accounts payables. They cannot make those accounts payable. So then they will have to borrow. But then banks are not lending. So what happens? So they go bankrupt. So this was the reason, uh, there was a widespread, the financial crisis into the widespread credit crunch that grew into a full-blown financial crisis. And then what does the Federal Reserve, what does the central bank do? The central bank will lower the interest rate. They will have to lower the interest rate because um, when borrowing is difficult, they make it easier to borrow by dropping the interest rate. Okay, but this interest rate that the Federal Reserve drops is only the benchmark rate, and uh, for that lower rate to fully propagate throughout the economy, right, throughout the banking system, it takes the mechanism. It goes through. We're going to talk about that in the later lecture, but that's why from 2000, since 2000, January 2009, the benchmark interest rate is somewhere between 0 and 0.25 all the way until 2016. And then from 2016, it just started to go back up. And it was almost like near 2%. It was near almost like 2%, 2.5% by the end of 2018. But then in 2019, there was some scare about the recession, but it didn't really go into, we didn't really go into recession. But then in 2020, the pandemic hit, and then there was just a brief recession, It was just a brief recession. We never went into recession. The economy is actually not that bad. The economy is not that bad. The economy is really strong currently. All this scare about inflation. I'm gonna talk about that later. But that's it's not. It doesn't mean the economy is weak. Okay. So anyway, so this is the brief, background history about the where the interest rate is now, why our interest rate is so low. And I told you it wasn't always like this. Early 80s, like even 83, 85, the benchmark interest rate was even 15%. And one more thing, I wanted to even talk about this, but then we are digressing too much, and we don't really have that much time. But one more question is: so why in the early 2000s? Why was the banking sector loaded with so much money? Why? I mean, the economy was, the second half of 1990s. Throughout the 1990s, the economy grew really. The economy grew due to technological breakthrough. But especially 95 through 2000, it was the era called dot-com era. But by 1999 and early 2000, the dot-com bubble bursted. So that's why there was a brief recession in 2001, 2000. But then the housing market pulled the economy out of recession. The recession was just about 1 year, very brief, and it was actually saved by the housing market. Then the question is, I said the housing market boom was instigated basically because the banking sector had so much money. But in the first place, the question is, why was the banking sector loaded with money, so much money? Why was the banking sector awash with so much money? When, as I said, 1999 through early 2000, there was dot-com bubble bursted, and which took the economy to a brief recession in 2001. But then, under such circumstances, why was the banking sector loaded with so much money? That question needed to be answered, but that's that will take another time. So I will just leave it to you as food for thought in the next class. So here, the reason we are talking about the interest rate is because it's the lowest return on your investment, right? Lowest return on your investment, and it's the safest return on investment. In other words, riskless return on investment. Why? As I said, if you put your money in the bank, right, say at least savings account or CD, CDs pay better interest than the savings account because CD is really a contract. CD is really a binding contract. But if you put your money in the savings account, we know you get very, a mediocre rate, like 0.1%, even less than that. But that is riskless, right? You're not taking any risk to earn that 0.1%. Bank always pays you 0.1%, and obviously, paying something like 0.01% is not that burdensome for the bank. So it would be risk-free. Also, another reason is, okay. Anybody heard of what CD is? CD, anybody? Does anyone know what CD is?
I think it's
Anyone?
when you put money into the bank, certain amount, and you're not able to use it until it's mature.
Right. Alicia, you're right. Mutkar, you have something to say, Mutkar?
She already said it.
Mutkar. So my question was, what is CD? Does anyone know? Alicia gave definition, but Alicia explained it. But that was an explanation that didn't define.
Certification deposit?
Say it again.
Certification of deposit?
Yeah, Tia. Yeah, it's certificate of deposit. Certificate of deposit. So both Alicia and Tia, you got 0.5. Yes, it stands for certificate of deposit. So it's a contract. It's a binding contract. So and the contract period is anywhere between 6 months to 2 years. But during this period, you cannot withdraw money. If you withdraw money, right, it's an early termination. An early termination is a breach of contract. So there will be a penalty. In other words, you want either, you don't get the interest, you forgo the interest, or, you just get partial interest or whatever. So CDs, certificate of deposit, will pay you better rate. I think some certificate of deposits may pay like 1% or 1.25% these days, but most commonly like 0.75%, which is compared to a 0.1% or even lower savings account, right? Interest on the savings account. It's much better. It's way superior, and it's risk-free. In other words, they will pay you that, and so that is the lowest interest rate, is the lowest return on the money. And another thing, you may have never thought about it this way, but when you put your money in the bank, think about it. You think you are making a deposit or you're saving, but from the bank's perspective, you are passively lending to them. If you put $10,000 in the bank, from the bank's perspective, it's borrowing, right? So that's why they pay interest to you, right? If it is not borrowing, they have no obligation to pay interest. But because your deposit is their borrowing, right? They pay interest to you, and you never thought about it this way. You never looked at it this way, but you are lending to them, but passively. You are lending to the bank passively. Okay, makes sense? So when you are lending to the bank, from the bank's perspective, it's borrowing. So the interest rate they pay to you, that's called borrowing rate, because from the bank's perspective, they are borrowing. It's called borrowing rate. And then when you borrow money from the bank, from the bank's perspective, it's called you pay interest, and that interest rate is called lending rate, because from the bank's perspective, they are lending. So whether it is called the lending rate or borrowing rate is purely from the industry perspective, not from your perspective. Okay? And think about it. So when you are lending to the bank, regardless of who you are, regardless of what your credit score, regardless of your income, you all get very low interest rate, like 0.1%, right? Whereas when you borrow from the bank, the lending rate, which is your borrowing rate, when you borrow, even if you have excellent credit score, you will be paying, the interest rate is about like 3.5%. Okay? Why? It's called prime. If you have excellent credit score, you get something called prime rate. And the prime rate is conventionally Fed funds rate plus 3%, about 3%, right? Fed funds rate. And what is Fed funds rate? It's federal funds market rate. It stands for federal funds market rate. And that's the benchmark. That's the benchmark interest rate. That's the benchmark rate, right? That the Federal Reserve sets for the commercial banking, for the banking industry. Okay, so here's the thing. So the lending rate something like 3.25. And this is when you borrow, right? This is when you borrow, right?
I thought that the FFR only goes only refers to banks borrowing from each other.
Yeah, Fed funds, that's Fed funds rate, right?
Yeah.
So if you are not a bank and you are an individual, just an individual customer borrowing from the bank, and if you have excellent credit score, you will get the prime rate, right? If you have excellent credit score, prime rate. That doesn't mean you can borrow at Fed funds rate. Okay, prime rate is when the actual borrower borrows, right? And prime rate is federal funds market rate plus about 3% conventionally. And currently Fed funds rate is, again, back to 0.25%. So that's why the, prime rate is something like 3.25. Does that make sense? And this is what you, this is the rate that you are charged, right? You will have to pay, if you borrow $1 million, you will pay annually, that's like $32,500. And that's called lending rate. Borrowing rate, on the other hand, and this is when you lend to the bank, when you save, right? Something like 0.1%, right? Not even 0.1%, but so then think about it. You can get when you get this prime rate, it's mainly because your credit score is very high. Because excellent, this means, you have excellent credit score, right? If you don't have great credit score, this rate will go up, of course. This rate will go up. Now, this symbol, does anyone know what this symbol means? Does anyone? 3 triangular dots, inverted or upside down? Does anyone know what this symbol means?
No.
Well, this means since or because, right? You get, so only if you have excellent credit score, you'll have, and then, so think about it. If you put $1 million in the bank, right, regardless of your credit score, you will get just 0.1%. Whether you have great credit score or not, you will get, no matter, whatever your financial status is, you just get, across the board, 0.1%. Out of 1 million, 1% is what? it's like $1,000. But, if you borrow 1 million, then $32,500, even if you, right? Even if you have excellent credit score. So think about it. And this difference between the lending rate and borrowing rate is called spread. Okay, in this case, the spread is 3.24%. Okay, so this is the bank's source of income. This is the bank's source of income. This is how banks make. So they lend money. They lend $1 million from Mr. X, right, to Mr. Y, and then they make this difference, right? So now that explains, the difference between, spread, lending rate and borrowing rate, which is, called spread. Now then, also the interest rates can be classified as nominal interest rate versus real interest rate, and simple interest rate versus compound interest rate. Now, I'm going to explain the difference between simple interest rate and compound interest rate first, and then next time, we'll go into non. It takes more time than, definitely takes more time than I thought. So we already know what compounding is because we saw the example of compounding in the previous section. In other words, we know price. We know 2006 house price is the result of 2005 house price plus the capital gains, right, or growth portion, right? The capital gains in 2006, right, which is basically. And what is the capital gains in 2006? Basically, it's, so if I rewrite this, capital gains is 2005 house price times the growth rate in year one, right? Growth rate in, year one. Isn't that right? That's, and then you all know the math doesn't like redundancy, right? This is not the best way to write it because math doesn't like redundancy because math doesn't like the same thing repeated over and over. So what do? Price 2005 price is the common factor.
You cancel them out.
You what?
Cancel them out.
No. You don't. Cancel means this is.
Or you cancel one now since it's a replica.
This is when you have x over x, right? This is canceling out, or x minus x. They are canceling out each other, right? That's canceling out. No, what you mean is, you factor out. You factor out the common factor, right? You factor out the common factor. So you factor out 2005.
Yeah, in a way I meant to say that.
Yeah, times. Then this is 1 because it's you factor out 2005 from this, it becomes 1, and you factor out this from the second term, it just become 1 times G1, so it's G1, right? So this is how we define or how we express 2006 house price. That equals, right? Right? And then just the same way, we already did that before, right? The same way, with this, by the same logic, right? 2007 house price, 2007 house price can be expressed as, right? We did this, right? 2006 house price plus 1 plus growth rate in year 2, G2. But because this, the definition of this is this, right? We replace P 2006 by its own definition. So it's like this. And if we keep going, right? If we keep going, even 2016 house price can be expressed by, right? 2005 house price and 1 plus G1, 1 plus G2 times 1 plus G3, and so on, until all the way to 1 plus G11, right? Basically, this is, this is compounding. But remember, when we found, if we found geometric average, if we found the average of these different growth rates, and then we can replace it by that average, then all of these things collapses into just this, because you have the same 1 plus G, 11 of them multiplied, 11 times. So it is, it becomes, 1 plus G raised to 11, right? 1 plus G raised to 11th power. So that's basically compounding. So in other words, in the long-term capital market, in the capital market, and financial market breaks down into long-term capital market and money market. Capital market is long-term financial market. Capital market means long-term financial market. Money market means short-term financial market. So short-term is, the line between short-term and long-term is, 1 year, right? If the maturity is under 1 year, that's short-term. If the maturity is above 1 year, that's long-term. So think about it. If you put let's say principal $10K, $10,000, interest rate 10%, time 2 years, okay? Then so if you put $10,000 in the bank, that pays 10% interest rate. Of course, that's annual, right? Then 2 years later, what's going to be there in your account 2 years later? What are you going to have in your account 2 years later? Anyone? Can you think about it? Look, it's just like this.
11.
We did already this. This is like, this G is like interest rate. Think about it. Interest rate is the growth rate, right? Interest rate is the growth rate that grows at a constant rate. In other words, why did we want to find the geometric average? In other words, we wanted to find the average of G1, G2, G3, right? They are all different. They are all different growth rates. Of course, annually, it's only natural that they all grow at a different rate. But we wanted to find the average of that, right? Why? Because once we find the average, then the whole thing collapses into this, simply this. So think about it. Interest rate is basically like the growth rate of your money. Isn't that right? Interest rate is the growth rate of your money. Right, everyone, right? Are you following? Okay, I can't, please say it. Yeah, please say it, because I can't, when I'm looking at this, I can't, this is what I see. This is only, right? This is the only thing that I see. Nothing else. I can only see what I'm sharing. I don't see on your screen. Maybe you see what the PDF file is in this space, but you see the right-hand side panel, but I cannot see right-hand side panel because I'm sharing this file, and that's taking up all my screen, so I can't see. So yeah, interest rate is the growth rate of your money, right? And it's always the same thing, constant. So it's like, this G. Then you can easily, so 2 years later, so you can plug it into, in other words, 2 years later, it's going to be just the same thing. The P 2005 is just 10K, G is 10%, and N is not 11, but 2, right? So you can find it. You can easily find it. It's not a difficult thing, but let me show you. So first, let me break it down. Based on that, at the end of the first year, FV1 means future value at the end of year 1. So at the end of year 1, what's going to be there? 1 year later, how much money will be there in your account?
11,000, I think.
11,000, yes, you're right. And who said that?
It's Mukhtar.
Mukhtar, yeah, Mukhtar, I'll give you 0.5 for that. Mukhtar. Yeah. We know it is 11,000 because basically it's 10K plus 10% of that. Okay. 10K plus 1K, which is not 10% of 10K. But if you break it down, think about it. This is P, right? Plus principal, right? Plus P times R, right? Principal times interest rate. Isn't that right? Everyone, isn't that right? No, you don't understand. This is P, right? 1K is principal times interest rate. Isn't that right? So, and then as I told you, math doesn't like redundancy. So we have a common factor. We factor out the common factor. So it becomes P times 1 plus R, right? Which is, then 11K. We know that. And then second year, we extend this logic. In the second year, right? In the second year, at the beginning of the second year, what is there? At the beginning of the second year, what is sitting there in your account?
What you had at the end of the first year?
10%.
Yeah, but someone said.
What you had at the end of the first year?
Yeah, right. What you had at the end of the first year, or 11K, right?
Mm-hmm.
So you have 11K at the beginning of the second year, and you will earn 10% of that, which is 1.1K. So then what's that? It's going to be 1,000. It's going to be, oh, come on, don't give me this. That's going to be 12.1K. Yeah, 12.1K at the end of year 2, right? That's called future value 2. But again, then, if you rewrite it algebraically, this 11K is Fv1, isn't that right? That 11K is Fv1, and that Fv1 earns interest rate of 10%, right? And then again, we know we don't write it like this because there's a lot of redundancy, right? So we factor out the common factor. Fv1 is the common factor. If you factor it out, this becomes Fv1 times 1 plus R. But then again, what's the definition of Fv1? Anyone? What is the I'm not asking for verbal definition. I'm not asking for verbal definition, right? When I ask for definition, it's always a mathematical definition. So what is the mathematical definition of Fv1? Anyone? We already defined Fv1.
Principal? No.
Yeah, principal what? We're running out of time. So this is Fv1, isn't it? We already defined it, isn't it?
Mm-hmm.
Isn't it?
I don't
Fv1.
remember the full term. I know it's principal or something.
Well, you can just say, you don't have to, you can just say P times 1 plus R.
Oh, okay.
Price?
Yeah. P is principal here, principal, because you're putting money in the bank, so it's P is principal, right? So think about that's, look, we defined Fv1 equals, which one is equal to, which one is equal to. So that's the definition of Fv1, right? And then we can replace the Fv1 by its own definition. Then it becomes, all right, this is P times 1 plus R, right? And then we have 1 plus R here. So this is not the, this is not pretty. I mean, this is not the right way to write it, right?
Oh, okay.
Right? This is Fv1. This is not the most, best way to write it. But then this is P times 1 plus R squared, right? This is compounding, and you already saw compounding because that's why I showed you. Look, this is why P 2016, right? Price 2016 is the result of P 1025 times 1 plus G, right? Compounded 11 times, right? In other words, this N is only, in our example, in our current example, N is 2. Right? Makes sense? Right? So we know future value at the end of year 2 is 1,210 or 12.1,000. Now this is how interest accrues in capital market, in long-term, right, financial market. But in the short-term financial market or money market, it doesn't work this way. Simple, in the money market, they follow short-term. They follow simple interest rate. They follow simple interest rate. So we're already out of time. So how the simple interest rate works, I will explain it next time. Okay. So we already, it's 3:46, so we're already done. So any questions so far? Any questions?
I have a question about the test tomorrow, right? Quiz.
Oh, you mean the diagnostic test, right?
Yeah. What's that gonna be on? Like, what is it
Well,
covering?
it's going to be on basically what you have learned so far.
Okay.
Hmm?
I also have
Is
a
it a
question.
multiple choice question or?
No, they are all math questions, straightforward math questions. Of course,
Okay.
yeah. Some of
All
them are
right.
multiple choice. Some of them are multiple choice. I think most of them are multiple choice, and just a few, straightforward, answer. But they are all, mathematical questions. Okay, so
Like how many questions will be there for 2 hours?
I believe 20 questions.
Okay.
Okay.
Okay, it's not visible to you just yet, but from you see 12, it's there. It's just grayed out, but at 12 noon, right? Friday morning, 0 hour Friday morning, it's going to become visible. Okay. All right. Any other questions? Any other?
Yeah. What are the answers to the test?
You will see the correct answers after you submit. Okay, I think.
Oh, it's gonna score it like immediately.
What?
It's gonna grade it immediately after you finish.
Yeah, it's graded by Blackboard automatically, right?
Okay.
All right.
Right.
I think it is. Your result will be. You will know automatically your result, but correct answers will be shown only after Sunday, after midnight Sunday. Okay,
Oh,
11:59
before you
p.m.
can.
Sunday.
Okay, yeah, that makes
Yeah.
sense.
Mhm.
Last question. The formula you were just showing us, right? What is that called? Like the answer that it gives you. What is the term for that?
You mean this, or rather, you mean this?
Yes.
That's called compounding.
No, I know I understand how the equation works. Like but what is that equation solving? Like what is it giving you the answer to? And that's like what's the term
Oh, this
for?
equation gives you future value too, meaning, look, once again, you put, this is the principal, 10K is the principal, so you put 10K in the bank. The bank pays you interest of 10% a year, time 2 years, so 2 years later, right?
Yeah.
What's gonna be there in your account 2 years later? That's called future value too, right? Future value two means, future value at the end of year 2, right? So in other words,
the whole equation just solves for the future value after however much time has
right.
passed.
This can be, t can be any number of years. T can be like, n, right? Any n. It's like, if I let me draw a timeline. I mean, it's basically. My mouse isn't working. So this is the timeline. This is time 0. At this point, you put 10K, the principal. 1 year later, 2 years later, 3 years later, 4 years later, 5 years later. Now, 5 years later, what's going to be there? Future value 5. Then it's 10K times 1 plus r, which is in our example 1.1 raised to 5. That's going to give you what's going to be there 5 years later, right? All righty. So my mouse is somehow. Oh, it's not. All right. Any other questions? All right. If you don't have any more questions, the class has been already dismissed. Okay. So have a great afternoon and good luck with your first diagnostic test. And I will see you next Monday.
Thank you.
Okay.
Thank you, Professor.
All right. You're welcome. All right. Take care, everyone.
Have a good one.
I'll stop. You two, I'll stop sharing, stop recording.